I want you to think about the last trade that reversed almost immediately after you entered. Not 5 minutes later. Not after a long battle between buyers and sellers. I mean the trade that seemed to turn against you the moment your order was filled. And here's the uncomfortable part. Sometimes that reversal is not bad luck. Sometimes it's information. Have you ever noticed how a setup can look perfect right before you enter, yet the market suddenly loses energy once you're in? The chart hasn't changed much. The story still sounds convincing. But something important has changed, and most traders miss it. The first thing to understand is that markets move because of imbalance. Price rises when demand is stronger than supply. Price falls when supply overwhelms demand. When you buy, what are you really betting on? You're betting that the pressure pushing price higher is still present. Not that it was present 10 minutes ago. Not that it looked strong on the chart. That it is still there right now. This is where traders get trapped. They see a strong move, they feel urgency, and they enter because the move already happened. But the very strength that attracted them may have exhausted itself. The late buyers arrive just as the earlier buyers are taking profits. The result: price doesn't reverse because your order somehow caused it. Price reverses because you entered at the point where the imbalance was fading. Think about that for a moment. How often do you enter because the market is moving, rather than because it still has room to move? That distinction sounds small, but it changes everything. A market that is truly healthy often gives you evidence after entry. It may not explode in your favor immediately, but it usually respects key levels, holds support, and shows continued participation. A weak trade behaves differently. Price hesitates. Momentum shrinks. Breakouts fail to attract follow-through. Candles begin overlapping. The market starts asking a question that your analysis never considered. What if the opportunity was already consumed? This is why experienced traders pay attention to behavior after entry, not just before it. The market is constantly giving feedback. The problem is that traders often ignore that feedback because they are emotionally attached to being right. Have you ever watched price struggle for several candles and still convinced yourself that everything was fine? The market was speaking. You simply preferred your opinion over the evidence. A useful habit is to observe what price does immediately after your position is opened. Does it accelerate? Does it hold the breakout level? Do opposing candles get rejected quickly? Or does every attempt to move in your direction get pushed back? Those small observations matter because they reveal whether your original thesis is being confirmed or challenged. And when reversals happen repeatedly after your entries, don't immediately ask, "How do I stop getting stopped out?" Ask a different question. What behavior am I consistently entering into? Because the answer is often hidden there. You may discover that you're buying into exhaustion, chasing confirmation that arrives too late, or entering exactly when other participants are beginning to distribute positions. The market can move exactly as you expected and still punish your entry. That sounds contradictory until you realize there is a difference between being right about direction and being right about timing. You've probably seen it happen. A stock breaks higher. A trend is clearly visible. The story makes sense. Everything points upward. You buy and almost immediately price pulls back. A few hours later, or perhaps a few days later, the market continues in the original direction without you. What happened? The problem was not necessarily your analysis. The problem was your location inside the move. Markets do not travel in straight lines. They advance in waves. Buyers enter, price rises, profits are taken, price pauses, and then a new battle begins. This process repeats over and over. The trader who enters late often mistakes evidence of a move for opportunity within a move. Think about it. Why does a setup look most convincing near the end of a short-term surge? Because all the evidence has finally become visible. The trend is obvious. The breakout is obvious. The momentum is obvious. But visibility and opportunity are not the same thing. In fact, they often move in opposite directions. As a move develops, uncertainty decreases. More traders become convinced. More traders become comfortable. More traders are willing to participate. Yet every new buyer needs someone willing to sell. The later you enter, the more likely you are buying from participants who entered much earlier and are beginning to take profits. That changes the balance. Price may still be in a larger uptrend, but your specific entry arrives at a moment when short-term buying pressure is becoming exhausted. The market is not rejecting the entire trend. It is simply digesting the move that attracted your attention. This is why traders are often confused by immediate reversals. They believe the market is telling them they were wrong. Sometimes it is saying something far more specific. It is saying you were late. There is an important distinction there. Being wrong about direction means your underlying idea lacks support. Being late means your idea may still be valid, but your timing forces you to endure a pullback that earlier participants avoid. The consequence is obvious. Your risk increases. Your stop must often be wider. Your reward relative to risk becomes smaller. And the emotional pressure rises because you entered at a point where the market needed to rest. Have you ever noticed how a move feels safest after it has already traveled a considerable distance? That feeling is precisely what makes late entries dangerous. The market rewards anticipation more than recognition. By the time everyone can see the move clearly, a large portion of the move may already be behind them. This does not mean you should predict every turn or buy every dip. It means you must learn to separate the quality of the idea from the quality of the entry. When evaluating a trade, ask a simple question. Am I entering because the opportunity is emerging, or because the opportunity has already become obvious? That question alone can change the way you look at charts. Instead of focusing only on where price is going, you begin paying attention to how far it has already traveled, how quickly it moved to get there, and whether your entry is arriving at the beginning of participation or near the point where participation is becoming crowded. One of the most expensive misunderstandings in trading is the belief that a good trade should move into profit immediately. The market never made that promise. In fact, if you study enough trades, you will discover something surprising. A large percentage of winning trades spend time in loss before becoming profitable. Not because the idea was wrong, because price does not move from point A to point B in a clean, uninterrupted line. This is where traders run into trouble. They treat any movement against their position as evidence that the trade has failed. But the market operates in probabilities, not certainties. A trade is not judged by what happens in the first minute after entry. It is judged by the entire path it takes to reach its final outcome. Think about a simple question. If every profitable trade moved directly into profit, why would opportunity exist at all? Markets are competitive because uncertainty exists. Buyers and sellers constantly disagree on value. That disagreement creates movement. And movement naturally includes temporary fluctuations against any position. This leads to an important concept. Every trade has a certain amount of adverse movement that occurs before it succeeds. Some trades experience almost none. Others require considerably more room. The point is that adverse movement is not an exception to trading. It is part of trading. When traders fail to understand this, they begin expecting precision that the market never intended to provide. They expect to enter at exactly the right moment. They expect price to confirm their decision immediately. They expect every winning trade to feel comfortable from the beginning. The numbers tell a different story. Even profitable trading systems often contain trades that move against the position first. The final outcome can be positive while the early experience feels negative. That distinction matters. A trade's temporary path and its final destination are not the same thing. Because of this, traders who only study winners and losers often miss valuable information. The real lesson is hidden inside the journey. How far does a winning trade typically move against you before recovering? How often does it happen? What is normal for the strategy you are trading? Without answers to those questions, every pullback feels dangerous. With answers, the same pullback becomes data. Notice how this changes your perspective. Instead of asking, "Why is this trade against me?" you begin asking, "Is this amount of adverse movement unusual relative to the trade's historical behavior?" That question shifts the discussion from emotion to statistics. The market does not care how a single trade feels. What matters is how a large sample behaves. A casino does not panic because one player wins a hand. An experienced trader should not panic because one position experiences temporary pressure. The significance comes from the pattern, not the isolated event. This is why records matter, not for finding certainty, for finding ranges. The market rarely offers exact outcomes. What it offers are tendencies. You may discover that your best setups regularly move 0.5% against you before working. You may discover that immediate reversals occur far more frequently than you assumed. You may discover that what felt abnormal was actually completely normal. And once you begin measuring these tendencies, something interesting happens. You stop evaluating trades based on individual experiences and start evaluating them based on expected behavior. The focus shifts from prediction to observation, from hoping to knowing. When price reverses immediately after your entry, your first instinct is usually to focus on your position. But the market is not reacting to your position. It is revealing information about itself. That distinction is important because every reversal is a message about the balance between buyers and sellers at that specific moment. The question is not, why is my trade failing? The question is, what is this reversal telling me about the market? Price can only move higher when aggressive buying is strong enough to absorb available selling. Likewise, price can only move lower when selling pressure overwhelms available buying. Every movement is a visible result of that hidden struggle. When you understand this, reversals stop looking random. They become evidence. Imagine price pushes into a new high and then immediately retreats. What does that tell you? It tells you that buyers were willing to pay higher prices, but sellers appeared in sufficient size to stop the advance. The important information is not the new high itself. The important information is the market's inability to remain there. Markets constantly test prices. They probe higher. They probe lower. Each test asks a simple question. Is there enough participation to continue? The answer is found in the reaction. A successful test attracts additional participation and extends the move. A failed test attracts opposition and forces price back. This is why experienced traders pay close attention to what happens after a breakout, after a support hold, or after a key level is breached. The event itself is only half the story. The response to the event reveals whether the market accepts or rejects that price area. Have you ever noticed how some breakouts appear powerful for only a few moments? Price surges beyond resistance, attracts attention, and then falls back below the level. The breakout occurred. Yet continuation never arrived. That tells you something valuable. The market accepted the higher price briefly, but could not maintain agreement there. The imbalance was insufficient. The same principle applies in reverse. A breakdown that quickly recovers suggests sellers were unable to maintain control. Again, the important information is not the move itself. It is the market's ability, or inability, to sustain the move. This is where traders often misread reversals. They focus on direction while ignoring acceptance. A market can reach a new price level without truly accepting it, and when acceptance is absent, reversals become likely. Think about an auction. A bid may be placed at a higher price, but if nobody else is willing to participate there, the auction quickly retreats to a level where buyers and sellers are more active. Markets behave similarly. Price constantly searches for areas where transactions can occur efficiently. When participation dries up, movement often reverses. That is why immediate reversals can be informative. They expose areas where apparent strength lacked commitment or where apparent weakness lacked follow-through. The reversal itself becomes evidence about the quality of participation behind the move. As you study charts, begin looking beyond the fact that price moved. Ask what happened after it moved. Did buyers continue supporting higher prices? Did sellers continue pressing lower prices? Did the market remain comfortable in the new area, or did it quickly retreat? These observations reveal far more about market condition than the initial move alone, because every reversal is a response. Every response reflects an underlying balance of supply and demand. A trade can be perfectly healthy while looking terrible in its first few minutes. That is a difficult idea to accept, because traders naturally want immediate evidence that they made the right decision. The moment a position is opened, attention narrows. Every tick suddenly feels important. Every small movement appears meaningful. The first few candles seem to carry enormous significance. But do they? Consider how little information exists immediately after entry. A few minutes of price movement represent only a tiny fraction of the market's ongoing activity. Yet many traders treat those moments as a final verdict on the entire trade. That is like judging a book after reading a single page. The problem is not that early price action contains no information. The problem is that traders often assign it more importance than it deserves. Markets operate across different time horizons simultaneously. Short-term fluctuations occur inside larger movements. Temporary reactions occur inside broader trends. Small bursts of buying and selling constantly compete with larger forces that take much longer to reveal themselves. Because of this, the first few minutes after entry can be noisy without being decisive. Price may move against a position simply because short-term participants are active. Price may hesitate because buyers and sellers are temporarily balanced. Price may drift sideways while larger participants continue building positions behind the scenes. None of those outcomes automatically invalidate the original trade idea. Yet traders frequently act as if they do. Why? Because immediate feedback is visible. The larger picture requires patience. And what is visible often receives more attention than what is important. This creates a dangerous habit. The trader enters based on one time frame and then begins judging the trade using another. A setup built around a larger move suddenly gets evaluated through every small fluctuation that follows. The standard changes. The trade is no longer being measured against its original premise. It is being measured against short-term noise. That shift creates confusion. A trader may abandon a valid position not because the trade failed, but because the trade failed to provide instant confirmation. Notice the cause and effect chain. The entry occurs. The market hesitates. The hesitation is interpreted as weakness. The interpretation leads to doubt. The doubt leads to action. And the action often occurs long before sufficient evidence exists. The market has not disproven the trade. The trader has simply demanded an answer too early. Experienced operators understand something different. They know that meaningful information often takes time to develop. A market does not reveal its intentions all at once. It reveals them through a sequence of behavior. One candle provides a clue. Several candles provide context. A larger period of observation provides understanding. Have you ever noticed how obvious a move appears in hindsight? What seemed uncertain at the beginning becomes clear later because more evidence became available. The market did not suddenly become easier to read. Time simply exposed information that was previously hidden. That realization changes the way you evaluate early reversals. Instead of treating the first adverse move as a verdict, you begin viewing it as a single data point. A data point can be useful. A verdict requires much more evidence. This distinction matters because markets are constantly generating short-term fluctuations that appear important in the moment, but become irrelevant when viewed within the larger development of the trade. The skill is not predicting every fluctuation. The skill is recognizing which fluctuations deserve attention and which merely reflect the normal process of price discovery. One of the biggest differences between experienced traders and struggling traders appears after the order is filled. Before entry, both may analyze charts. Both may identify opportunities. Both may build a reasonable case for the trade. But once the position is open, their behavior begins to separate. The struggling trader watches. The professional observes. At first glance, those sound like the same thing. They are not. Watching is passive. It is simply staring at price. Observing is deliberate. It means looking for specific information that either supports or challenges the original idea. This distinction matters because the market continues providing information after entry. The trade is not finished when you buy or sell. In many ways, the market's most valuable feedback begins at that moment. Yet most traders never develop a process for collecting it. Instead, they react emotionally to whatever happens next. A small move higher feels encouraging. A small move lower feels concerning. A period of sideways action feels frustrating. The interpretation changes with every candle because there is no framework for observation. Without a process, every movement appears equally important. With a process, certain movements matter while others can be ignored. Think about a doctor examining a patient. The doctor does not collect every possible piece of information. The doctor looks for specific signs that help evaluate a diagnosis. Trading works in a similar way. Once a position is opened, the objective is not to watch everything. The objective is to observe key behaviors. Does price hold the area that justified the trade? Does movement in the intended direction occur with conviction or hesitation? Does the market respond constructively when challenged? These observations help reveal whether the original idea is developing as expected. Notice what is happening here. The focus shifts away from prediction. The focus shifts toward evaluation. That is an important change. Many traders believe their work ends after making a forecast. Professionals understand that forecasting is only the beginning. The market then provides evidence. And evidence deserves attention. Have you ever entered a trade and later realized that the market had been signaling weakness long before the trade actually failed? The clues were there. Price struggled to advance. Key levels failed to hold cleanly. Momentum faded. The market was communicating. The problem was not a lack of information. The problem was a lack of observation. This is why developing a post-entry process matters. A process creates consistency. Consistency creates clarity, and clarity improves judgment. Without a process, every trade becomes a unique emotional experience. With a process, every trade becomes an investigation. You begin asking the same questions every time. You look for the same forms of evidence. You evaluate behavior through the same lens. As a result, your understanding becomes more objective. Another benefit emerges over time. Patterns become easier to recognize. When observations are collected consistently, recurring behaviors begin standing out. You notice which types of trades strengthen quickly. You notice which types of trades struggle early. You notice which forms of price action frequently precede continuation and which often precede deterioration. These lessons are difficult to discover through memory alone. They become visible through structured observation. That is why the period immediately after entry should never be treated as dead time. It is an active phase of information gathering. The market is revealing whether reality aligns with expectation. When price reverses immediately after you enter, the most important question is not what the market is doing. The most important question is what you are going to do. Because once the position is open and the market moves against you, a decision must eventually be made. Hold, exit, or adjust, and the quality of that decision often matters more than the reversal itself. The market's initial move is simply information. What turns information into profit or loss is your response to it. This is where trade management begins. Not before the entry, not during analysis, but at the moment reality starts interacting with your expectations. Many traders treat trade management as a collection of rules. In practice, it is a process of interpretation. The market presents new information. You compare that information against the conditions that justified the trade. Then you decide whether the original opportunity still exists. Notice the sequence. First comes observation, then evaluation, then action. The order matters. When traders reverse the sequence, problems appear. They act first and evaluate later. They panic out of positions before understanding what happened. They hold positions long after evidence has changed. They make decisions based on movement alone rather than meaning. A reversal is not automatically a reason to exit. A reversal is simply a reason to reassess. Those are very different things. Suppose you enter a trade based on a specific expectation. You expected price to hold above a certain area. You expected participation to appear at a certain level. You expected a particular behavior from the market. Now price begins moving against you. The critical question becomes, has the expectation failed, or is the market still operating within acceptable boundaries? That distinction separates disciplined management from emotional management. A professional is not responding to discomfort. A professional is responding to evidence. Why does this matter? Because every trade contains uncertainty. If every small adverse move triggered an exit, many valid trades would never have enough time to develop. At the same time, if every adverse move were ignored, losses could grow unnecessarily. The challenge is not eliminating uncertainty. The challenge is responding appropriately to it. That requires defining in advance what would actually invalidate the trade. Without the definition, management becomes reactive. Every price movement feels significant because there is no standard for evaluation. With a definition, the situation changes. The trader is no longer asking, "Do I feel comfortable?" The trader is asking, "Has the condition that justified this trade changed?" One question is emotional, the other is operational, and markets tend to reward operational thinking. Have you ever noticed how some traders exit the moment a trade becomes uncomfortable, only to watch it recover afterward? The issue is often not the reversal itself. The issue is the absence of a framework for interpreting the reversal. Without a framework, every pullback looks threatening. Every pause looks suspicious. Every fluctuation demands a response. The result is constant intervention, and constant intervention often destroys the opportunity the trader originally sought. Effective trade management is different. It creates separation between market movement and trader action. Not every movement requires a response. Not every reversal deserves adjustment. The objective is to determine whether the market's behavior is changing the trade's underlying condition. If it is, action may be required. If it is not, action may be unnecessary. This is why skilled traders spend less time reacting to price and more time evaluating context. They understand that management is not about controlling the market. It is about controlling their response to the market. One of the most common reasons price reverses after entry is surprisingly simple. You entered at the point where the opportunity became obvious. The market had already done the hard work. The move had already developed. The evidence had already accumulated, and that evidence is precisely what convinced you to act. At first, this seems logical. After all, shouldn't stronger evidence lead to better decisions? In many areas of life, yes. In markets, the relationship is more complicated. Because the more obvious a move becomes, the more participants begin noticing it. As participation increases, attention increases. As attention increases, orders increase. And when large numbers of traders begin acting on the same visible information, conditions start changing. The opportunity that looked attractive may now be attracting everyone else as well. Think about a breakout that receives widespread attention. The level is clear. The trend is visible. The move is being discussed everywhere. Confidence grows because uncertainty has decreased. But notice what happened. The market became attractive because it already moved. The proof arrived after the movement. This creates a paradox. The trade feels safest precisely when the risk of poor timing may be increasing. Why? Because visibility attracts participation. Participation creates crowding, and crowded trades often struggle to maintain the same momentum that created the crowd in the first place. The issue is not that obvious trades never work. The issue is that obviousness changes the environment. The market you are entering is no longer the market that existed before the move became visible. The participants are different. The expectations are different. The positioning is different. That matters. A developing move and a widely recognized move are not the same thing. In a developing move, uncertainty is high and participation is limited. In a widely recognized move, uncertainty is lower and participation is broader. As more traders arrive, the balance between potential buyers and existing buyers begins to shift. And when that shift occurs, the market often becomes more vulnerable to reversals, pauses, or corrections. Have you ever noticed how a chart can look almost perfect right before a pullback begins? That is not always a coincidence. A perfect-looking chart is often the result of a move that has already convinced a large number of participants. The very conditions that create confidence can also create vulnerability, because markets move through the interaction of expectations. When expectations become heavily concentrated in one direction, it takes less opposition to interrupt the advance. The market does not need everyone to sell. It only needs fewer new buyers willing to continue paying higher prices. That subtle change is enough. Momentum slows. Price hesitates. The crowd that arrived for continuation suddenly encounters resistance, and a reversal begins. This is why traders should pay attention to how visible an opportunity has become, not because visibility is bad, but because visibility carries consequences. The more obvious a move appears, the more important it becomes to ask who has already acted on that information. If thousands of traders can see the same signal, the signal itself is no longer the entire story.